Hey, folks, for episode 65 of the Rental Roundtable, we had on two guests. We had on Joe Kondrup. He is one of the co-founders of United Rentals and the CEO and founder of Catalyst Strategic Advisors, who helps advise rental companies selling their business. And we had on Josh Mosko, who is a guest number 11. He was previously at CES Power. He just started at Catalyst Strategic Advisors a few months ago. So really fun episode. Joe shared some war stories from the initial days starting United Rentals. And we talked a lot about the M&A process for an independent rental company, why people start a rental business, when they should sell it, what should they sell it for, what are the valuation drivers, and a lot of the mistakes that rental companies can make. We talked about the future and the growth of rentals, talked about technology and how important that is. One of our longer episodes, really fun episode to have on with Joe and Josh. I think you guys will enjoy this one. All right, everyone, welcome to the Rental Roundtable, episode number 65. We have on Joe Kondrup and Josh Mosko. Guys, welcome to the show.
Hey, good morning. How you doing?
I should say, Josh, welcome back to the show. You were guest number 11. We used to do these live on Zoom, and here we are. We've 65. You've come back for round two. And Josh's new role as part of this at Catalyst Strategic Advisors, been there a couple months. And Joe, you've been there longer than a couple months, I think almost 20 years as the CEO and founder. So Joe, good to have you on today. This episode is going to be a lot about rental valuations, buying and selling a rental company, and M&A. So guys, thanks for coming on today.
Yeah, thanks for having us.
So Josh's long background, we could talk about if you go back to episode number 11, but I'd love to hear your stories, guys. Josh, maybe a briefer one because, we've covered that in detail, but Joe, for you as well, you have a lot of experience, several decades in the industry, obviously very early as a co-founder of United Rentals as well. So maybe Joe, if you want to start, tell us about your story and how you got here today.
Yeah, great. Well, thanks again, Kyle, for having us on. So my background and professional career spans, 4 decades now. So I grew up in the waste industry in the 80s and 90s, and then 1997 or 1995, actually, I was recruited by Brad Jacobs to join a waste company called United Waste. Worked together there for a couple of years. And then Brad invited me, along with a handful of other folks, to join him to start United Rentals. So I've been around the rental industry since Labor Day of 1997. So at United Rentals, my job was to do acquisitions. So in the first 3 years at United Rentals, we did 240 acquisitions. I did over 100 of those personally, supervised a bunch of the others. We built a $3 billion platform in a little under 3 years. And then over the years, we matured the business, added systems, technology, bought Rental Man in the early days, Win Systems, I think it was at the time. So we built out the platform. I was with United from day one in 1997, and I was, I think, the last of the founders to leave in 2006. And then I started Catalyst in 2008. The Catalyst business, so whatever that is, 17, 18 years now. We focus on working with entrepreneurs that want to pursue a strategic opportunity in their business. Could be to grow and recapitalize, could be to make an acquisition themselves, could be to position for a sale, could be to execute on a sale transaction, could be in response to somebody calling in and saying, hey, would you have a conversation? So over the last 17 years or so, we've handled probably an average of 10 deals a year, some years more, some years less. Last year, we completed, I think, 13 transactions, about $1.3 billion in enterprise value. Our biggest deal was about a little over $250 million. Our smallest was about $20 million. That's pretty typical for our range. Specialty rental, pump, power, temperature control, trench safety, general rental, aerial, and some of the smaller but also critically important, sweeping and lifting gear, and there's a number of other kind of subsets and specialties. So we kind of work across those areas. And our perspective and why I founded this business is I was always really impressed with the entrepreneurs that had the guts and the wherewithal to start these rental businesses and risk their treasure and expend significant amounts of brain power and energy and effort to build them. When their time comes to do something strategic, my view is always that, look, I've been there, done that. I can help you navigate this because I've got a perspective as a buyer. So that's what I did for the first 30 years of my career, 25 years of my career. I was a buyer of businesses in the waste industry and the rental industry. And I thought, you know what? I did a square deal for everybody I ever did a deal for, but when they were unrepresented, which was 99% of the time, they just didn't have somebody to coach and help them through the process. Catalyst is a team about 25 people, Josh and a number of others that specialize in accounting and transaction services, transaction execution. And what we really focus on is being experts in our sector so that we can add value for our clients. So that's probably more than you needed, but that's it.
Well, we're going to talk a lot about Catalyst the rest of the conversation. A lot of people have a lot of respect for United Rentals, obviously the leader in the rental space. You're one of the co-founders. What was that? I got to ask, like, what was it like in 1997? Did you think it would be the behemoth it turned out to be? Like, do you have any war stories, any cool insights from what that was like in the very early days? You did over 100 transactions, it sounds like yourself. What was that like back then?
It was intense. It was pretty wild.
Yeah.
At the peak, I was closing a deal a week. And so to do that, you have to have you're always cultivating new relationships and negotiating new letters of intent and working deals through the closing process. But the most interesting thing is we never started out to be that. Hertz at the time was best in class. Dan Kaplan, who actually worked with us pretty closely in the early days to help us understand the industry and how he thought about it. Hertz was the big dog. Hertz was the big dog at the time. I think they had 250 or 300 million in revenue. And our goal was really to be best in class and to be rewarded for being the best operator. When we started the business, we thought that scale, purchasing power, technology, the ability to leverage scale in markets and regionally and nationally was really something that, was latent potential that hadn't been fully realized in the industry. So when we started out, our goal was to, be a solid number 2 or 3 or 4 player over the first 5 years. And at the time we started, you had RSC and you had NES and you had a number of other players that were also acquisitive. And when we got started, we were very pleased and surprised by the response we received because we came to the market with an experience from the waste industry that was very blue collar too. And we were very comfortable in the environment with the rental operators. And it was just pretty intense. So, I probably got hundreds of stories I could bore you with for hours and hours. But it exceeded our expectations. And once the momentum built, we went with it. And, a lot of great people, a lot of people worked really hard. We were blessed to work with a lot of great entrepreneurs that built terrific businesses who trusted us to be stewards of their business going forward. We did a lot of things right. We did a lot of things not as good as we could have done them. But United, after, I think mid 2000s, United went from a serial acquirer. They still are very acquisitive, but they really have done an amazing job in running just a great business and built a culture and built systems and technology and career opportunity. And so I look at them and I got high regard for all the big companies and the small companies, but the United guys don't.
Yeah, the market leader. I can't imagine doing one transaction per week. Imagine maybe not a lot of beach vacations at that time in your life.
No, not a lot of beach vacations and kids in high school and other, life. So it was intense on many levels. But one of the things that, one of the anecdotes I will share with you was we probably heard once a week from somebody, could have been a high profile person in the industry, is like, you guys are never going to succeed. You're going to fall on your face. Smarter guys than you have done this. And, good on you. Have a good time, but you're going to flop. And when I look at people starting companies today, I never dismiss what they can accomplish in the industry, because if you organize your balance sheet pretty well and you've got a good go-to-market strategy, you got good people, you're in a good market, and you really are being the provider of choice, you can win. So when we were early days, like, yeah, you guys are going to fail and it's a house of cards and you're never going to win. We heard that every week from somebody. And we just kind of kept our head down and kept working. Matt Flannery, who I still talk to regularly, and a lot of the guys over there I worked with back in the day, I talk with them and they just do a great job and built a great business. So again, more than you wanted to know. But
I guess last question, if there's one thing that led to the success of United, the tremendous success that even exceeded what you even said you thought it would be like in 1997, there's 100 variables, I'm sure, but there's one thing that really stood out that led to the success of United. What would you say that was?
So I would break it into the formative years where the building was growing rapidly and creating mass. And then the maturing phase that started, 2000s, probably when the company bought RSC. United bought RSC. I would kind of there's a break point in there somewhere where the company went from a serial acquirer to a really Six Sigma, Kaizen, whatever you want to call it, kind of focused business. It's been on this long trajectory to be best in class, best in the world. So I'm going to answer the question. In the early days when I was there from 97 to 06, it was, I think, kind of three things it's not just one thing that stands out. I think one, we were exceptionally aggressive in achieving a mover advantage, right?
Mm-hmm.
Once you buy a great business like 40 Rents in Seattle or Power Rents in Portland or Able Equipment in Alabama, lots and lots of others, you had to leverage those. Achieving a mover advantage by buying great companies was one. Moving aggressively to grow those organically, and number three, being very aggressive in how you integrated and managed the financial controls, right? So we were really good at those things. Well, we were less good at a number of other things, right? And a lot of those didn't get perfected till much later. Go-to-market strategies, compensation programs, how you share fleet, and a lot of that was technology driven. But I would say our mover advantage and our ability to just see that opportunity and capture it through mover advantage was really the differentiator. And Brad gets the credit for that. Brad was the guy that really was the architect and the visionary and the driver of go get it. Let's make it happen.
And being aggressive about that, it reminds me of Uber. I worked there briefly as well. They saw a market opportunity and they were very aggressive, right? And they made some mistakes, et cetera, but they got market share pretty quickly. I think that's a good lesson, right? When you have conviction and these moments in life in a market, they're not open forever, but when they're open, going for it, right?
Well, and you're going to make mistakes, right?
Yeah.
Valuation of business is not perfect. There's a margin of error that you can operate within and be just fine. You go too high, you can get trouble. You go too low, you're not going to get deals done. But seizing that market opportunity, like you say, when it's available, once it's gone, right?
Yeah.
And, if you buy a great business and you build a great business through a combination of acquisitions and organic, how you did it on day one matters less than what you did with it in the first 5 years, right? Did you preserve the culture? Did you nurture it and build it? Did you energize it with, talent and both human capital and financial capital? So yeah, no, Brad was really, and he's done it with a couple other businesses since. Yeah, it's a great, exciting, amazing, career opportunity for me.
Yeah. Well, thank you for humoring me on the United side. A lot of our listeners would be very interested in some of those insights. Brad's got a great book, How to Make a Few $1 Billion. I've read it. It's very subtle, not $100 billion, just a few $1 billion. So
a few billion. Yeah. It's just modest,
a few billion,
right? Yeah. It's
modest. Just a couple billion, 2, 3.
Yeah.
So, but Josh, I'll get to you briefly. I know we've done a longer episode, but Josh, you want to share your background as well?
Yeah. No, thanks again, Kyle, for having me. It's great to be back, and it's great to see the podcast kind of flourish and the consistency that you've put into it. So thanks, from an industry standpoint, I think just having content and people talking, I think it's great, and hard to follow up after Joe. So, I'll have to be, a little less exciting for the audience, but 25 years in the space, the majority working for kind of mid-size and large rental companies, in conjunction with Joe there, I was there, 2000 to 2006. We were the first specialty branch, power and HVAC branch. I'm in Connecticut. So we were the first branch. So that was my kind of early days at United and seeing things flourish and talking about growth over the next few years and specialty, and to see what it's done since then, right? In the last 25 years, we can get into other stuff on specialty, but, I've been fortunate enough to kind of travel the globe with rental companies, and being an operator. I've been on the sales side, biz dev side, fleet side, operations, been able to play in a lot of different roles. So really love the industry and been fortunate enough to be in a lot of roles. The last several years working with CS Power, being on the buy side, spent the last 4 years, we acquired 15 companies, spent a lot of time on the buy side. And myself, I've been fortunate enough to have 2 exits. One is the software startup and an exit selling to private equity. So I've also had the experience on the private equity side as well as the strategic side and publicly traded company sides. A lot of different lenses to kind of look at, and it's super excited to be here at Catalyst and kind of the culmination of all those things to be able to really help, rental companies and I'm hyper focused on specialty from that standpoint, right? So specialty is really my focus in helping folks with kind of strategy and eventually transaction and building long-term relationships and really network. And so I'm out and about within the industry and just talking to folks and seeing where I can add value and see where Catalyst can add value. And we've got a great team at Catalyst, so I'm super excited to have all the reinforcements in the back, that all the smart people, doing all the modeling and transaction and due diligence. So it's an exciting time, and excited to talk more about the M&A and all things.
Yeah. Exciting time to be in rental. And Josh, you're right. You are traveling a lot. Every time I see you, I feel like you're at an airport. We're crossing paths. So you're
I'm
actually,
glad to hear that.
I don't know if he's actually getting on the plane. He may just be hanging around the airport, but he's, I've seen him at the airport a couple of times now.
Yeah.
So let's get into the rental side of things, right? So I guess first question is, why do most people start a rental business? What drives someone to, take on the capital risk, put in the sweat equity? It's not an easy thing. It's not for the faint of heart. Why do people start a rental business, and what should the end game look like if you're an owner who's starting a rental business?
Well, look, I don't know why people start rental businesses. They may have some kind of crazy wish to work like a madman for 16
Yeah.
hours a day. But look, I think when you look at the people I've worked with, acquired businesses from over the years, the reasons are really varied, but it usually just comes out of, classic American entrepreneurism, where they perceived an opportunity and had the guts to go after it. Some were electrical contractors and knew that they rented a bunch of scissors or fire protection, or they were sales reps for one of the big OEMs, or were in the construction trades and saw how much gear was on the job. So people start rental businesses for a variety of reasons, and a lot of the folks we've worked with over the years, we sold a company called Ross Rentals in Phoenix several years ago. Ross Richards, great guy. He's got a picture of his pickup truck and one little trailer and a 19-foot scissor, and that's how he started his business and bootstrapped it up from there. And that story is repeated over and over and over again. So I think people start them for a variety of reasons, just to pursue the American dream of entrepreneurship. There's certainly people that start them more as financial decisions and, more as a, strategic financial investment opportunity. And it's kind of across the spectrum. But I think the reason people start business is really kind of driven out of what their lifestyle and end game goal really is, right? Do I want to work for myself, control my own destiny? Do I want to take that risk? Am I building the business to pass down to my kids or my grandkids? Am I building the business to sell it? Do I want to generate cash flow for the next 5, 10, 20 years and then, figure out what my exit is? So I think why people start very personal, but it's largely overwhelmingly driven just by that entrepreneurial drive, perceived opportunity. So, I think if you talk to people that listen to this podcast and you talk to entrepreneurs or people that you work with every day, Kyle, you'll get that, across the spectrum.
And I think too, it's interesting. I mean, you see generational now, right? You see folks that started business 50 plus years ago, and it's generational, and that kind of family business. We see a lot of that, right? It's really exciting to see that. And I think also now you're seeing a lot of intentional folks that are really looking at rental in terms of, how do I grow it, flip it, and really think about it from that standpoint and look at the returns and, like Joe said, kind of feed that potential lifestyle and really even in the community, really help kind of support the community and hire people and really build a business. So I think there's some interesting things that you're seeing, and you're seeing folks that sell a business and then kind of restart, several years later, right? So it's really interesting mix, but we really see a lot of intentionality too now with the investment community that are, starting businesses and folks like yourself, Kyle, right? That your story, great story with Home Depot and trying to rent a piece of equipment. And we see a lot of tech enabled founders now, right? Tech enabled, whether it's some part of the industry, and we're seeing that more and more. So a lot of exciting reasons to start, and it's served a lot of families and a lot of folks. It's a great industry.
Yeah, it's almost like I feel like people, why do they start it? Well, they can't not start it. They have to. Like, it's in their blood. It's personal. Every week we meet someone, at least every week, who's starting a rental business for the first time. The guy with the trailer. And by the way, a lot of them don't make it, to be honest, right? But the ones who do make it can have amazing stories. And then every month we meet someone, Josh, we talked about this, a second time founder who started the business. They sold it to a national, non-compete ended, they have to get back. Yeah, they could sit on the beach, but like, man, they love this stuff, and they come back for the second bite.
That's what they know. No, I would agree with that, and I would say that the thing that most people, if they don't understand it going in, but they figure it out very quickly, it's a very capital intense business, right?
Yeah.
There's just no getting around it, and the ones that don't make it, or if you study small business formation and growth and survival, a very small percentage of businesses that start make it 5 years.
Yeah.
And I think in capital intense businesses like equipment rental, which is as capital intense as anything, people go into it with the right balance of grit, determination, and hustle, and enough cash to go.
Yep.
A little vendor support, relationship with your bank, they can make it. But yeah, we've worked with a number of clients that wasn't their first rodeo.
Yeah. And you've got the battle scars, and you learn, and software is also capital intensive. So 91% of software companies don't last 3 years. 96% don't get to $1 million. So I know that world, and it's not for the faint of heart. So we talked about why people start a rental business. How do you think about the end game? Like, you're 5 years in, 10 years in, and you've kind of made it past you've crossed the chasm, the point of no return. Do you pass it down to your second generation, third generation? Do you sell it? Do you sell it to a strategic or private equity? How do you think about the end game for an owner?
So, the ownership end game is really just we find that owners often want to create a succession plan in their business, whether it's with a child or a key employee. But in order to do that, and to eliminate their personal risk, because they're personally guaranteeing the debt, they've got to create some kind of plan that allows that risk of loss and that transition and that ownership to kind of move forward. And that's where a lot of those get hung up, right? Because even if they pass it down, when they go on vacation, they're still guaranteeing the bank loans. And, bad things happen, then, they're not actively involved in the business day to day. There's a different kind of risk for them. So the ones that pass the businesses down generationally tend to solve that problem in some form or fashion, right? Through not just the passing the business down in name, but creating legal partnership documents or LLC agreements or whatever it is that really starts to create that transition. So, but some people don't want to do that. A lot of people just hear what's going on with acquisitions and say, well, I'll just sell it when the time comes, and I know this buyer, that buyer, somebody, or my phone rings periodically. So a lot of people, just assume that when their time's ready, 5, 10, 15 years down the road, they'll figure it out then. So I can pause there, but I can add to how that does and doesn't.
Let's do it.
So Kyle, you started a rental business and you say, you know what, I'm going to build it up. When I get to 5 million of EBITDA or 10 million of EBITDA, I'm going to look to sell it. And the valuation will be between, 5.5 and 6.5 times EBITDA. And I know what I'll sell it for. And you can do the math around what that will mean to you personally. The reality is that if you watch the stock charts of the publicly traded companies, and you watch the stock market, and you watch interest rates, and you watch just the cyclicality and the economy that we live in, you don't often get to pick your time, right? Nobody knew how the industry would soar coming out of COVID after just falling on its face. And used equipment prices went up, and new equipment prices went up, and physical and economic utilization went to all-time highs. And then as the demand in the economy moderated a little bit, it moderated to kind of where we are today. We're off the top. And, so that affects value. And if you take a look at the white space that the big acquirers, United, Sunbelt, Herc have, 3 years ago, they had a lot of white space. Today, they have less white space. You've got equipment share making moves in the market through organic growth and a variety of acquisitions. You've got some super regional players like REIC and ERG and Synergy and a few others. And then you've got some regional players. So the timing of your exit, if sale is your objective, needs to be thought about over an arc of time, so that when you look out into the world and you think about the value of your business, who the universe of buyers might be, how that universe affects, motivation and interest and value. And then on top of that, are you very passionate about where your people end up? Or if that's not as important to you, your universe might be a little different. So one of the things we work a lot with clients on is, what are your personal goals? What are your financial goals? What are your lifestyle goals? What's your timeline look like? And they say, look, I want to sell the business over the next 3 to 5 years. Then we always like to engage in that conversation sooner than later, so that we can develop what their options would be, because we can't just say, okay, we're going to do it tomorrow, right? We're not going to pick up the phone tomorrow and just do it tomorrow. So I think on the exit, whatever that looks like, advanced planning, and it doesn't need to be 10 years, but if you look at the volume of acquisitions and the value of those acquisitions on a bell curve, right? The bell curve just kind of ebbs and flows over time, right? And I could tell you who buyers are for businesses today. I couldn't tell you who's going to be buying businesses 3 years from now. Good news is, and Josh said this earlier, the industry has achieved a level of sophistication, a level of interest, and a level of understanding where we're seeing private capital come into the market, private equity, well-funded entrepreneurs that have, friends and family backing or their own personal wealth. And, the industry is going to continue to grow. When I got into the business with Brad Jacobs in 1997, it was under 20 billion. It's probably 80 or 90 billion today.
Yep.
The adoption rate in the late 90s was, the rental, how much equipment got rented versus owned was 20, 25%. It's probably 65, 70, 75% today. So, the future's bright and there will be opportunities, but there's a bunch of variables that will affect what your exit looks like and when you want to execute on.
And I've been in 5 years. The industry was about $60 billion according to the ARA. They're saying 87 billion this year. I mean, that's tremendous growth, right? It's outpacing GDP, plus rental penetration's increasing as well. It does seem like there's a leveling up though of more sophisticated money coming in, private equity, and I think that has a lot of other implications. You mentioned trends and opportunities in rental, right? Like, what are some of those trends, growth opportunities you guys are seeing right now, especially for an entrepreneur who's listening and going, I'm a couple years into my business, or I'm thinking about starting. What are some of those trends that are happening in the rental space right now?
So, if you follow the big three, United, Sunbelt, and Herc, and you look at their blueprint of having a very strong and solid specialty offering, creating more sticky relationships with customers through their specialty offerings, pump power, temperature control, trench shoring, whatever those things are. The trend that we see is that there's a great market for your classic general rental business, your classic aerial business, but to really create sticky long-term relationships with customers and be more than just supplemental capacity, right? Mm-hmm. They diversify their portfolio. So some of the companies we see that have dirt focus, naturally add trench shoring equipment, trench boxes, shield shores, road plates. So the trends really are to be a more sophisticated and one-stop shop. Mm-hmm. And the specialty rental, as Josh has spent a huge part of his career in, there are technical requirements, there's product knowledge and expertise, and application understanding and expertise that really enables the rental provider to differentiate. So, it's not just, hey, send me 19-foot scissor lifts. 10 guys can do that, right? But if you say, look, I need some scissor lifts and I need I need some temperature control, and we need to make sure that, we're not only controlling the climate, but humidity, because we're doing drywall and we need to dry and do all. So the trend really is to be that one-stop shop. The ability to do that really depends on your capital, availability of capital, your balance sheet, your ability to attract talent, to have people that can really deliver those service solutions. I think that's the overarching trend. That and technology. I mean, technology is just unbelievable. And when we started out, we had Wind Systems, Rental Man, but that was like Stone Age compared to what exists today.
Yeah, I think Joe summed it up really good. It's interesting. I always think and tell the story at United Rentals in the beginning days when we basically measured stuff. We'd look out in the yard and say, is it empty or is it full? And that would be the barometer of how we were doing. It wasn't dollar ute really, or we really weren't thinking like that in the beginning. But the metrics obviously have come in a huge play, and dashboarding and all the technology. And I think, with telematics too, and, equipment and data and all the information, obviously, making it actionable is a big part of it. So, and as Joe said, I mean, if you listen to the investor call at United Rentals the other day, they said 40% is driven by specialty now in their business. So, I mean, it's just a massive number. 40% of the behemoth is specialties. Yeah. And I think it's really that engineered solution is part of it, as we talked about a little bit. It's people, but it's really engineering the solution for the customer in terms of sizing and really kind of the application based, right? It's not that commodity, like Joe said, of just a scissor lift, give me 5 scissor lifts type of thing. This is, an engineered solution that's driving value and, minimizing downtime. And I think now you're seeing also the mega projects, right? I mean, a massive amount of infrastructure and data centers and, the projects that are out there. So I think that's been a trend, the last few years of really some of these mega projects and the amount of, let's say power and cooling for some of these data centers and, kind of keeping with the specialty theme. I mean, it's just, there's a massive amount of projects, large projects going on. So really interesting. And obviously sustainability is one of those things too, right? In terms of, I want to even call it a trend, but it's definitely with the tier emissions, with anything kind of engine driven, you have a lot of different things that are kind of geared, when you're thinking about sustainability and the footprint on some of these projects, right? So yeah, a lot of interesting things that have happened. And then I think one more thing that comes to mind too is just, all the accessories, right, that come with the equipment, not just the equipment, but you're renting, cable and distribution and ducting and attachments and, all the other things, right? So really interesting. And I think a lot of the reason why is we were talking about market penetration and rental penetration. The rental companies do it really well and they've gotten better over the years. So why am I as an owner going to think about, owning all this equipment and moving it around to jobs in different states and regions and all that when, you have a lot of rental companies that have done a really good job at it, right? So I think all the things have kind of culminated to where it's at. And yeah, there's still a lot of upside, right? If you look at Europe and you look at Japan, really mature markets, you see what they've done with rental penetration. So it's, I think the next several years are got a lot of growth. So it's exciting times.
Yeah, Josh, I'm thinking about the days of people looking at like trying to see what their utilization is, and they don't have the computer program. They're looking out. I think it's 50%. And our previous guest, right before this episode, is a big Oakland Athletics fan. I know Josh, you're a Yankees fan. Moneyball. So he had lunch with Billy Beane, and Billy Beane said that when they interviewed people, if they found out you were a sports fan, they wouldn't hire you because they wanted pure, objective, analytic quant people, right? Because if you're a fan, you may go, Giambi, I like him. We're going to give him a little bit extra bump. So it was like an extreme version of like, we're going to run by metrics and analytics. And I think that's sort of where the industry is moving a little bit more, right? It's becoming more, you got people who love construction equipment and they love being out there, but you have this financial sort of persona and they're just running their business on numbers and spreadsheets, right? And I think you can be successful that way.
Yeah. And
100%.
I'd be remiss if we didn't, just talk about the AI topic for a second as well. I mean, in terms of the trends and what's happening, and we talked about it before the call a little bit in terms of just, what can you do with AI to take all that data and information and make it actionable, right? Whether it's with your fleet, your workforce, damage detection, whatever it is. So, it's just really interesting to see where AI has come the last 5 years. I was involved with AI in the early stages with the damage detection and to see what's going on with all the software and what you guys are doing, Kyle, and some things that are coming in the industry. It's a game changer. It's cliche to say game changer, but I think in this instance, there's some interesting things that'll develop with AI and just taking all that data and making it actionable. So it'll be interesting to watch.
Yeah. And I mean, if my wife is here, she'd be like, Kyle, stop talking about AI. So I will limit myself because we could have a whole separate episode. This is what I think about every day. I do think AI, game changer, put it lightly. I think what's going to happen is you have these agents that are actually doing work that wasn't being done. For example, one example, right? You get all these phone calls that come in every day and you're trying to log missed rentals, Today AI can listen to that, transcribe it, give you all these analytics. And by the way, I'm not saying this should happen, but it's happening. You guys have probably talked to AI voice agents, haven't realized that, you can talk to some people and
Oh,
negotiate rates and right. I mean, you can think about where the industry could go. I'm not saying it should or will, but it may look very different in 5 years.
yeah, I think that's very true. And I think that the way I think about the industry is, and this is probably a little off topic, but as a rental company, you're essentially a bank and your currency is equipment, right?
Mm.
You're trying to generate a return on that invested capital. It represents itself in iron, right? Scissor lifts, boom lifts, backhoes, skid steers, whatever. And the ability to drive efficiency and profitability and reduce risk in your balance sheet through technology. If I'm an operator that has a $50 million fleet or a $100 million fleet, I'm going to find every tool I can find to de-risk my balance sheet so that I not necessarily can, sure, I'd love to be more profitable, but the one thing we see more often than anything is operators, as you were saying, Kyle, they see to the pants, right? They look out in the yard. Well, we're doing pretty good. I don't see a lot of gear. And the reality is that when we work with clients, one of the first things we do is we get a buy unit download of their fleet and their physical and dollar utilization, and look at stuff that's been on rent less than 10% of the time or not at all. And we were looking at a deal the other day. A company had a $30 million fleet and they had 7 million of fleet that hadn't rented and for one day in all of 2024. And
Did
I'm
they know
like,
that?
no, they didn't know it till we asked the question and we extracted the data.
Hmm. So I think
And
that's a great.
it's a really nice business and they do very well. And they've got a 50+% EBITDA margin. We see that all the time. And I think the migration towards as generationally as you guys' age, not my age, that grew up with a different level of technology, are using AI and other technology tools to really manage their business more productively, manage their balance sheet. That's going to continue to transform and make the business better, the industry better.
Yeah, and Joe, when you were telling me about when you started United Rentals, I was in elementary school, so technology has changed a lot. I think one of the things, but I sort of loosely talked about this on AI, these agents here, but like agentic technology, right? But like reality is, you have all these business systems out there, rental management systems. You have all this data, and you could spend all day looking at it, and you're still going to miss things, right? But what these agents, what they can do is they're smarter than us. They don't take cigarette breaks, and they don't ask for raises, and they work 24/7, and they should be able to tell you, hey, you've got $7 million of fleet that hasn't been rented a single day in 2024, and put that at the top of your inbox, right? Those are like the very low hanging fruits, stuff that's going to exist. It's happening right now. I think even by 2026, that's just going to become table stakes. I think what happens is you become way more efficient and profitable. And if you're not using technology, I think the gap of where technology was and where it's going, you're going to be left behind within a matter of months or years.
Yeah, and I couldn't agree more. And I think there are 100 other impacts that I think technology will influence. That, like you said, if you're not on board, you're going to get smoked because 2, 3, 4, 5 years down the road, if you're still doing it off a clipboard in the yard, you're just cooked, right? Because the world's going to be light years ahead of you.
On the M&A side, when you think about the valuation drivers, I guess what are the things that help determine what a rental business is worth? Number one, subtext is technology adoption. Is that part of this as well? So you have rental business A, who is on paper and clipboards, and it's like super outdated. Operation B, same exact metrics, but they're on the latest cutting edge technology, and they've got telematics and the whole system's integrated. Is First question is, what are the valuation drivers for a rental business? And number two, is technology adoption part of that at all? Part of that equation?
Okay. So on the second question, yes. But so I'll answer this question with kind of the arc of time in mind, and the drivers of value ebb and flow today versus next week versus next month versus next year based on who are the buyers and what's their motivation, right? Are they filling white space? Do they have a mandate? They're generating a ton of cash. They got to reinvest and find ways to grow. They've got to take capacity out of markets because growing organically is great, but Dallas can only absorb so much rental fleet, right? So if you just keep throwing fleet in there, you're going to dilute rates. So at some point, you got to take capacity out of the market through acquisitions. But what are the value drivers of a general or specialty rental business? it's really just good, well-rounded fundamentals. Okay. Customers, right? Not too much concentration, not too small, not too big, good revenue history. You acquire that customer, you build on that relationship. You can show a trend of revenue with that customer over years that says, we landed it here, and over the last 5, 6, 7 years, we've built a relationship. So customers, people, I want those people, management, technicians, truck drivers, fleet. You're managing proactively. You're paying attention to your fleet metrics on what's renting and how the rates and ROI profile is. Not too old, not too young. We don't want to see a 20-month-old fleet. We don't want to see an 80-month-old fleet. 40, 45 months. Yeah, and it can move here and there. Customers, people, facilities. Are the facilities sufficient to run the operation, well maintained, good proximity to market? You've got the right coverage in the market to handle logistics properly. And then the market you're in. Are you in a hot market? Are you exposed to some of these mega projects? Can you tap into infrastructure projects or big data centers? So, there are great business in small markets that do tremendously well, but, you're probably not going to get a lot of buyer interest in a small market of 25,000 people, even though you might have a great rental business that serves a 50-mile radius. So the markets you serve, and if you look at and we maintain data on all this, how many locations each, the top, CAT, United, some all have in the top 100, actually all MSAs. And we track their penetration based on number of locations, and we do some math around that. So it's really, for me, it's 5 things, and it's really a fully formed, well-rounded, well-run business. When somebody looks and says, those guys do a good job, they know what they're doing, they're players. Customers, people, fleet, facilities, and the markets, right? And the market may be the most important one of all, because the universe of investors in rental, they're just going to be more excited about it. As far as tech adoption influencing value, absolutely, right? Tech adoption, and I would say implementation and application, right? Not just we got it, we don't know what to do with it, but we got it. It's really the cornerstone of how we run our business. And we have a human factor, we have to make judgments, but we're watching this data every day, and we're driving performance in managing our fleet and organizing our sales team and how they pursue opportunity and how we're responding to customer service. So 100%. Now, private equity buyers will look at that technology as a standalone platform, as something they can leverage to grow and make the business more profitable. Strategic buyers will look at that technology as, okay, this business will assimilate. We use something different, but it does the same things. So while we might not maintain this technology, the people coming across understand how to operate in this environment. And because they do, that's a good fit for us. We don't have a science project to integrate this business. So I might add on what drives is integration. We've seen a lot of deals where it affects both buyer interest and value if the business has lagged in terms of any of those factors, including technology, and the buyer looks at it and says, we don't have time for a science project here. We don't have time for a fixer-upper. So just a fully formed, well-run business doesn't need to be the most glitzy thing in the world, doesn't need to be the sexiest thing in the world. Just you look at it and say, those guys got it going. Now, when we do the math to figure out how all those things influence value, it can get pretty complicated. And when we are working with our clients and the potential buyers, we go to great lengths to bring those kind of features and attributes out in a way that really allows the potential investor, the potential buyer to fully understand and appreciate it, as opposed to just coming to their own conclusion.
I think as well, I think Joe hit on a lot of good points. I think, when we talked about how we engage people, obviously years ahead of time too, right? We can kind of look at the current state of the business and talk about when they're looking to exit, or talk about future state, right? 1 year, 2 year, 3 years, whatever it is. And maybe they need to kind of modify what they're doing a little bit too, right? Is it, we talked about fleet, for example, is it, getting into new markets, new market verticals, new customers, using technology, putting the right team in place, right? Do you have the right management team obviously the people side of it is huge, right? Especially if you are going to a investor-based private equity type of company, right? To have a good management team in place that can scale the business, right? Can they take it to the kind of the next level? As part of it. And then, do you have contracts with customers, recurring type of revenue, those type of things, right? So you see more of that in terms of, what the opportunity is to kind of be sticky with the customers and, add all those kind of bundled solutions. So it's a lot of different things that'll kind of move the number in a range, right? And on specialty, obviously you're getting some higher multiples too, right? You're getting a couple different turns more than kind of that gen rent space, right? I mean, in terms of, there's just not a lot of those fully formed businesses in specialty that you can acquire, right? They're a hot commodity, and the people that operate those and the people that really understand kind of those engineered solutions, those are coveted kind of folks. Specialty kind of demands a bit more higher multiple from that standpoint. And there's a lot to think about, a lot to look at. And, that's really what we do at Catalyst, to kind of look at that business and really help and guide too, right? To make some modifications and, really get that maximum value when it does come time to transact. So, yeah.
Yeah, on the technology piece, I think you guys made a good point. Like, the buyer may not be on the same platform you're on, but the most important thing is you're using a platform, right? And you make it ding because of that, because you don't want to have to train someone on, hey, here's why you need to enter the rental contracts and the software, and here's how you look at utilization. They already know that, and where the button is on the screen may change, but they're sort of embracing technology. Time's been flying. We're almost out of time here. I got two final questions. First question is, if I'm a rental owner listening to this, I've heard of Catalyst and appreciate everything you guys do for the industry. Why should I sell my rental business?
Why? Very personal. It's just lifestyle, risk reward. And this, everybody's got their own perspective, but your business is an investment like anything else. If you bought 100 shares of Apple, or pick any public company, and there's a time to create, there's a time to build value, there's a time to harvest value. And when people need to harvest value, there's a couple, 3 or 4 ways you can do it. You can go to the bank and recapitalize your business and borrow a bunch of money and leverage your business up and do a distribution and keep owning your business and have that. But you have to repay that debt. You can bring in a partner that can monetize, some of your business, or a very high percentage, or you can sell it to a strategic. But why is really just harvesting the equity value that you've created over a period of years or a lifetime or generations. None of us know what the stock market's going to do tomorrow. None of us know what interest rates are going to do tomorrow. And why sell your business is, as basic as, how do you manage the financial and lifestyle risks and rewards in your personal life. But that's different for everybody. Some people have set goals that say, look, when I get here, I'm ready, or I've got 5 more years, or I don't know, I don't play golf, I don't know what I do with myself. But the why is just really personal, and it just really comes down to how you harvest that equity value and when you harvest it to align with your life.
Yeah, some of the things, I would say too, it's super interesting, talking to folks on all sides, right, in terms of, on the buy side or sell side, right, in terms of, mitigating risk, like Joe pointed out a bit, at some point, right, the world's changing, things could happen, a COVID can happen, things can happen where the world changes on on a dime, right? So I think taking some chips off the table is something that people think about, right, is obviously a reason. That the age of the ownership, transition from there, what happens from a health standpoint. I was working with a company where the owner didn't want to sell, but all of a sudden he had a real health scare, and he's like, wow, what's my business going to be worth if I'm gone, or what's my family going to do, type of thing. So I think there's a lot of those kind of thoughts that go into it. And then I think, the other interesting thing is that I think from a deal structure standpoint, you see a lot more kind of options out there, right? When you bring in the investor community, when you can roll over equity or do some other things, right? Doesn't have to be just all or nothing in terms of just selling 100% of your business. And what we've seen a lot too is that, some of those folks who get a couple bites of the apple, they may retain a certain percentage, and they may make more money on the second turn or the third turn. So there's some interesting opportunities now, I think, that didn't exist as much before. So I think there's a lot of different ways you can kind of paths you can go down in terms of the why and the when and the how and all those things. So, I think that's something obviously that we talk about, and, folks are starting to think about a little more and are getting more educated on it. Right. I think a lot of people, this is their first time and maybe only time in their life selling the business. It's a huge deal, right? It's transformational. It could be generational wealth, whatever it is. So, a lot goes into it, but yeah, there's a lot of good discussions around the why.
So, Kyle, I don't know your last question. I think the bigger question is when. When do you sell your business?
When do you sell it?
There's a great book I just
maybe
read.
I was gonna ask one other question. The other part of this: when do you not sell it? When is the wrong time to sell it? What is the wrong driver to sell it? Sort of thing. That's sometimes even more informative.
So, when not to sell it? When not to sell it is not necessarily when you're in a trough or when you're in a crisis. I would say just when the economy around you is in a crisis, but that's not a hard and fast rule. I mean, the world could change and be upended in ways where you don't have a choice, right? So the key to having flexibility on when you sell or when not to sell is your balance sheet. Okay. So if you go back to the early days when we at United Rentals started in the business, the financial community, stock market really hadn't figured out rental and didn't understand it, and the capital intensity and replacement capital. But look, if you've got 2.5 turns of leverage, 2.5 times EBITDA of debt on your balance sheet, and you've got ability to take a blow and have some diminished utilization, and you can still take care of your business, and you can right size as you need to. So I would say the time not to sell is when you're in a dip or something that you're perfectly capable and healthy to ride through. When to sell, the fallacy in when to sell is, well, I'll be ready in 2 years, and I know what multiples are, values are. I'll just, X times Y equals Z. Or I got 5 million EBITDAs today, and I can get 6 times for that. And when I get to 10, I'll get 6 times that. Well, if you look at the trading multiples of the public companies, they go as high as 8, 9, 10, 12 times down to 4.5, 5 times. And applying the X times Y equals Z math is a big fallacy, right? Because by the time you get to 10 million of EBITDA, instead of getting 6.5 times, maybe it's 5.25 times. And your fleet's a little younger and your debt's a little higher and your equity value isn't as good. And the return on invested capital and the commercial risk you encountered to get there didn't really generate a return for you, kind of the money ball, right?
Yep.
So if you're building your business just to make a financial decision and exit, what you really need to think about is the risk reward profile from that point to your exit point, and what you need to do to manage it to actually increase your equity value, generate a return on the capital you invest. So I think one of the biggest fallacies we encounter is, well, I'm not ready and I just want to wait to hear because I can, my equity value is going to go up. I'm like, do you really have a plan to make sure that you're actually getting that incremental improvement in your equity value? And you really have a plan to make sure you're managing to that. And the other thing we tell people is, look, we know who the buyers are today. We knew who they were 6 months ago or a year ago. We have no idea who they'll be 6 months from now or what the world around us will look like. So what you need to do is think about, look, my exits, I would like my exit to be in this window of time, right? And then we need to plan for timing within that window, right? And that window could be a couple of year period. So anyway, a lot of variables. We spend a lot of, we often meet with clients 3, 5, 7, 10 times before, they get familiar enough with us and we know enough about their situation to talk seriously about when they want to hire us or somebody like us. And then our planning and service cycle with them. We've worked with clients 6 months and gotten a deal done. And, we're working with a client right now we've worked with for over 10 years, who when we started was in his mid 40s and now he's in his mid 50s. Now's his time. So the when and the how, they move together.
Well, the future is uncertain. And I think it takes a lot of humility to know that and to say, yeah, I can have this chart about how it's going to be straight up and to the right, and everything in the world, it's never going to rain. It's going to be perfectly sunny every day. That's not the world we live in. And I think having some flexibility and some humility in that is important, right? Well, it's been awesome having you guys. I think it's been our longest episode. We could go another hour. I'm sure Josh has got another flight to catch. He's always traveling. So I'll wrap up with my closing question I ask every guest. I'll start with you, Josh. Best career advice you've gotten that's helped shape your success? Anything you want to say, Josh? Then kind of turn it to Joe.
Yeah, I would say it's an interesting question. I think, I was taught at a young age to kind of learn everything about the business. And, that served me well because, I started out in the field and really from a hands-on standpoint, setting up equipment and all that. And, like I mentioned before, being in all aspects of the business and learning the metrics and learning the financial side and all that. So I think for me, it was being well-rounded to really understand all aspects of the business. And then if I'm managing people, I'm not asking people to do things that I haven't done in the past. And I think, that served me well. And I think that served me well moving forward and talking to owners and folks who are operating businesses that are looking for some advice and looking to figure out how to scale. Right. So, yeah, that would be my first thought.
Great. Joe?
I don't know if this is wisdom or not, but pretty good ain't good enough. Okay. And be the person that your coworkers, your boss, your customers want to work with because you solve problems and you make their life better. If you do that, you'll succeed every time.
I like that. Pretty good isn't good enough. I thinking about that bumper sticker. Be the person your dog thinks you are. Live to higher. But that's great. Like I think a lot of people settle for good enough, right? And I think we all can do better. So, was awesome.
Yeah, I'm not good enough now. I'm every day. I'm chasing better. Right. It's a life pursuit. But yeah, that was the advice my dear old dad gave me as a junior. Pretty good ain't good enough. Get her done. But the young people or everybody over is like, look, just be the person people want to go to because you just make their life better.
And on the growth mindset side of things, one of my mentors has told me, he's like, Kyle, you're not the CEO. You need to be in a year. Right. And it's that, and I get there in a year and I'm still not the CEO. I need to be the next year. Right. And I think that's constantly chasing better. Right. So, it's been fun having you guys on. We'll have to do another one here in the future, but Josh and Joe,
let us know.
Thanks again.
And if you want to get into a specific topic, just let us know. We'll love to join you sometime.
Yeah.
Awesome. All right. Thanks, guys.
Thanks, Kyle.
Thanks.
We'll see you.